Check out my savings account. I dropped $1,000 in here a year ago, and with 5% interest, I've now got $1,050. But the price of my daily latte has shot up in the past year. Ouch. I might have earned $50 in interest, but rising prices, inflation, have eaten away at the value of that money. $50 now buys me less than it did last year. So whenever you save or invest, you're always in a race against inflation. If you're earning 5% interest, but inflation is at 5%, prices are rising as fast as your money is growing. So the real rate of return on your savings is in fact zero. That's why some people invest in stocks, property, or other riskier assets. They're hoping they'll earn a decent real rate of return. All investments carry the risk of losing money, but some are generally considered riskier than others. Short-term government bonds are probably the least risky investment. You lend your money to major governments that have a long history of paying back their debts. They pay you interest while you hold their bond. The upside? It's low risk, as long as you avoid lending to countries that have been known to default, to not pay their bond payments. The downside, you likely won't make much more than you do in a bank account. With longer-term bonds, you're lending your money to the government for years or even decades. On the upside, the interest payments typically tend to be a bit higher than short-term bonds. On the downside, you're tying your money up for a long time. And if you want to cash out early, it's possible you could lose money on the investment. This is particularly true if interest rates rise, because bonds and interest rates have an inverse relationship. When one goes up, the other goes down. Stocks are usually considered medium or high risk. Medium risk for big public companies, aka blue chip companies, that typically churn out profits year after year. Higher risk for newer, fast-growing companies that don't have established financials or might be in financial trouble. Riskiest of all are alternative investments like cryptocurrencies. Some of these rise by thousands of percentage points in a single year, but then can fall back down just as quickly. Generally, the higher the real rate of return you're shooting for, the greater the risk you have to take.